All right. Good evening, everyone. Thank you for joining. This is our second session on technical analysis. And today we are going to cover two important indicators, VWAP and moving averages. And VWAP doesn't have any variations as such. And moving averages have few variations, like simple moving average, exponential moving average, and Hull moving average. And there are a few other moving averages, which we will go into detail in this session. But before we start, I want to, I'm assuming most of the people on this session are very new to technical analysis, and you're trying to learn technical analysis. This session is basically focused on who want to really get into technical analysis rather than people who already know, because it will be very basic. And it will move a little slow. It won't move. It won't be intermediate or advanced at this point. And assuming that most of you are new, I will go through what exactly is an indicator, and the platform that I'm using is Think and this is a free trading charting software. And then once you create an account with TD Ameritrade, a brokerage, you will be able to use Think for free. And I use Think for charting. I do not use TD Ameritrade for trading. I use Webull and other brokerage accounts. But for charting, I use Think I don't use anything else. So what is an indicator? In our previous session, we have looked at the charts and the time frames, right? Like the candlesticks. What is the time frame? How do we basically look at each candle and say if the market is going up or down, and what does each candlestick represent, and things of that nature. And then what is the time frame and how many time frames do we have? How to create a custom time frame? What does 1 day, 1 minute mean? And all those details. Now, when we open a chart, on Thinkorswim or any other charting platform for that matter, we see all the candlesticks, and then we see the time frame, right? Like this right now, I have 1 year, 1 day, and then I have a regular candles on the chart, and it is very blank and very basic, right? So let's just say I want to do intraday. That means I want to trade somewhere around like 9 o'clock and buy something around 9 o'clock and sell something by 12 or 1 p.m. So that is called day trade. You buy and sell on the same day. That's called a day trade, right? And then when you open a day trading chart, which is 1 day 1 minute, or 5 day 5 minutes, or 1 day 5 minute, whatever it is, when you open a day trading chart, it is very confusing, right? I mean, you see the candlesticks. You can know just by looking at the candlestick, where is the open, where is the close. We can see that, but it would be really helpful if there is some way that could help us, to show the direction of the market, right? Or but just by looking at this, it looks like the market is going up, but then it just came down here, only for it to rally again. This is just yesterday's chart on SPY. So if we have some indicator, it will really help our life. And then I just want to really say this out loud before we get into indicators, that there is absolutely no magic indicator. If anyone is selling you a magic indicator, or any YouTube video or anything tells you that this indicator will help you make money, or this indicator will predict what's going to happen next, do not believe it. There is no such thing. And I'm telling you, I'm telling that after creating many indicators myself. There is no such thing as an indicator that will tell you what is going to happen next. Absolutely no indicator can tell you, right? So I just want to put that in front. However, indicators may help us to understand the direction of the market, or the strength in the direction, or strength in the trend, right? And there are few indicators that the market makers, some of, not the market makers, sorry, the hedge funds and then some money managing firms who do day trading and who buy and sell, their positions based on some of the indicators, right? So I want to quickly touch base on one such indicator that many hedge funds use. They don't use any other indicator. They will use one indicator, and that's called VWAP, right? And before I just get hands-on and show you how VWAP, what VWAP is, and how to add it on your chart, just let's look at the quick definition by Investopedia. I don't want to create definitions; it's already there. I don't want to reinvent the wheel. But then if we basically look at what is VWAP, VWAP basically combines the price and volume and plot it in one single indicator. There are only two things that are important when we are looking at the chart or a market. That is price. The price is here on the chart, and then the volume. The volume is down here. Those are the only two things that are really important when we are looking at a price action, right? So when you see a candle, a bullish candle, followed by a large volume, that means there are many buyers, and there are a lot of buyers in the market at that given minute. Then there are sellers, right? And then the volume is high. That means that the market participants are high. But since this is the first candle, it's always going to be high. But then when we look at the following candles, the combination of the candlesticks or the price action combined with volume will help us get a better understanding on where the price action is going. But most of us do our day job, and then we just look on a different screen, or we just look at it a mobile, and then it's hard for us to basically correlate the price action with the volume. And then this indicator VWAP basically helps us combining the price and the volume. And then if you basically look at the how it is calculated, it is cumulative typical price into multiplied by the volume divided by the cumulative volume. And the typical price is high price plus low price at that given point plus closing price divided by 3. And then the cumulative, meaning the total since the trading session opened. What that means is VWAP will only work for intraday and then for a daily chart. If we want to look at VWAP for a previous day, we have to look at a different indicator. It's called anchored VWAP. We are not going to look at anchored VWAP. We are only going to look at VWAP, and then it only covers that particular session. That means the VWAP will only cover from here till here. It will only cover from the start of the day till the end of the day. It will not calculate the previous day's volume or after hours. It will only calculate during the day, right? So it basically, if you go to studies on Thinkorswim and click on edit studies, go to VWAP. I have few other VWAPs. Those are custom VWAPs. Forget them for now. This is, if you see this lock symbol here, that means it was created by Thinkorswim, and it is an official Thinkorswim indicator that we can use. If you see this lock symbol here, if you do not see a lock symbol here, that means those are custom indicators that are created by people like me or anyone that's outside, right? If you see a lock symbol, that means this is authorized, that can be used by Thinkorswim. So we select the VWAP, we click on add selected, and then by default, you're gonna see -2 and 2. Those are the standard deviations. We don't wanna look into those, but we're not going to cover the standard deviations today. But if you simply click apply, this is what you're going to see on the VWAP. The middle line, the pink line here, that's the VWAP. This is the upper two standard deviation. And this is the lower two standard deviation. Okay. So we don't want those standard deviations. So when you guys are going to add the VWAP, type VWAP under studies, select it, hit add selected, and go to the settings. And then you will have a few options here. You go to upper band and uncheck the show plot. Go to lower band and uncheck the show plot. This session is being recorded, so if you guys want to go back and look at these settings again, the video will be uploaded to YouTube and the link will be provided. So you go to the VWAP and then you click on settings, the gear icon here, and then you come to upper band, uncheck this, lower band, uncheck this, and then the VWAP itself should be checked. Okay, so I've checked that and I've clicked apply. Now I have one line, is just one indicator or one line on the chart along with the price action, that is VWAP. What this means is that this price right here, if I go to here, for example, if I go to this price right here, the price that the VWAP is showing means that the cumulative of the price with along with the volume divided by the cumulative volume. It says the VWAP price should be 404, right? But the actual price is somewhere around 405, right? So this is considered as the price that the volume and the price action combined is what this price should be. This is like, this is the practical price where it should be. And this is the price where it is. So there is a gap, a price gap between the actual price where it should be based on the volume and the price action versus where it is here. So this line is where most traders in the institutions or hedge funds will consider as a line of defense, right? What that means is when you have a strong push to the upside, and then there will be a pullback. Obviously, there will be pullbacks in any market, right? So when there is a strong push to the upside or when there is a strong push to the downside, the price tends to find its mean or the average price where the market participants are trying to agree, which is VWAP in most cases, right? So when you find a strong push upside, you have to wait for the price to pull back to the VWAP and then continue in the direction that it has started. When I say pull back, that means the price should go up, come back to the VWAP, and see how the price action is happening around the VWAP. When the price meets the VWAP, and then followed by the successive candle is continuing in the direction that it started. In this case, it started in a bullish direction. It pulled back to the VWAP, and then it continued in the bullish direction again. Again, it made a strong pullback. It didn't quite reach the VWAP, but then again, there was a continuation, right? So the day traders who basically come in and out in 5 minutes, or any one of you who don't have a lot of time, but maybe you have time for like 30 minutes or 1 hour or 2 hours. You can plot VWAP and then see where the price is, right? This is the reality. This is where the reality of the price is. If the price is too far from this reality, then you may have to think if you want to buy here, right? If you remove VWAP, you don't have the reality. You don't have any calculation. I mean, you can come in here and buy, take a call, or just buy something here, only to see that it goes down. Well, eventually it went up, But if you're buying zero DT calls, the theta would have probably killed unless you go in the money by the end of the day. Do you want to buy here or do you want to buy here? We don't know where we want to buy. We need some kind of mechanism to get us into reality, the reality of the price, along with the volume, along with the market participants. And that is VWAP, right? You want to buy as close as you can to the VWAP, right? And then, I mean, you can buy here, for example. If it was me, I would have not bought here because it did not quite come to VWAP. I used to trade using VWAP many months back, or maybe a year or so back. And my theory was like, when the price comes and touches the VWAP and then picks up, that's when I used to buy. It could be upside or downside, right? So this is reality. VWAP is the reality. And then the reason why we want to use VWAP, one more reason why maybe using VWAP is better is because, you know, the big money uses this indicator. They don't have anything. If you see any prop firm or a trading firm, if you see any of the screens, they will only have one line, and that's VWAP. They don't use anything other than VWAP. They don't use, you know, moving averages or clouds or anything as such. They simply use VWAP. So what they do is if the price touches VWAP and closes above VWAP, they will get into the long position. And then their stop loss could be anything. They may be using ATR or ADR, or they may simply use VWAP again. But then their theory is that when a price goes up, it meets VWAP, it should go in the direction of the VWAP, of where the price started trading. Here it's bullish, came, retested, went all the way up, right? Here it came down like a second retest. It never came quite close to the VWAP. It just started picking up again, right? But let's just say that's a positive side of it. Let's just say we were checking something else and then we missed the whole first part, right? So by the time we open the screen, SPY is already here. So it came here, it's testing VWAP at this point. It picked up, so naturally anyone will think like, okay, so it picked up here, so I want to enter into I want to buy some calls. You'll buy a call only for it to go up a little bit and come down. So the point here is that one needs to have strict stop loss. Like I said at the beginning of the session, there is no magic indicator. VWAP, the price will fail. It won't just touch here and just go up all the way. It doesn't happen. If that was happening, then most of us would have been billionaires by now. It will break VWAP. So here, if you see here, it broke VWAP. And then one thing that we have to see is that how strong did the break happen? So this is a big candle if you compare to others. This is a very big candle with, you know, significantly higher volume. So this yellow line here, this is the average volume for the last 50 bars. This volume right here is higher than the last 50 bars. So one should exit here. You can enter again. But if you still hold it, the chances are high that if you buy here, if you don't sell here, the chances are high that it may just go down lower and lower and lower, right? So if you see here, it picked up here, it came here, it tested here. The buyers try to buy more and more and more, but then the sellers took control over here. There is no point to hold the calls, or there is no point to be in the trade. Get out here. Once the price crosses the VWAP in the opposite direction than what you have entered, just look at the volume. If the volume is high, just get out. There's no point, right? And then again, it went down. It came up here again as a retest. And then typically one would buy puts here, or one would short the stock here because it went for a retest. If when the retest happens if it closes less than the VWAP. But in this case, it did not close less than the VWAP. If you see this candle, it just crossed the candle, it just crossed the VWAP, and the candle closed here, right here. That means you would not go short, but we will go long here because it tested VWAP here, the candle closed here, right? It came here, it tested VWAP, it closed higher. We will take a call only to sell it for a loss. Again, here the price goes back up, up, up. Here, it tests VWAP, but it cuts the VWAP and closes above. After 4 or 5 minutes, comes back for a retest. Look, it came for a retest, and then it closed here. It closed above VWAP. You take a call. There is your retest. Take a call, and then you ride all the way up. How one closes, see, from here, it went all the way up. One can have their own rule book on where they want to close. My personal rule book is that if I'm trading, when I was trading VWAP, so for example, I bought it here around 404, right? For example, I'll probably buy like a 405 or 406 call. Like I'll maybe buy a 405 or 406 call. When the price gets in the money, I will sell it. I'll not look back. I will not look back. I don't have ATR, ADR, all those levels for me to take the profit, or I don't have the Fibonacci levels. I don't have them. If I'm trading purely based on VWAP, I just want my contract to get in the money and I'm out. That's it. As simple as that. I'll enter here, for example, 409, 404, I'll buy a 406 call. Somewhere here, I'll be out. I'll make like 30%, 20%, whatever it is, and I'll be out. I don't want to wait and see where it goes. Like, you know, we all see like turning $100 into 10,000. No, I rather take $40 and go home rather than wait. And who knows, like it can just go touch here, 406 and go down, right? So we never know that. So when one is trading purely based on VWAP, you have to first let the price cut it, come back for a retest, and then go in the direction that you want to go, right? Like this, it came here, it retested here, it went up, but then it didn't hold. So you have to take a loss somewhere here. You have to look at the volume, you have to look at the candle, and then you have to come out of the trade. There's no point holding this. Hope should never be our plan of action. So that's one point that all of us as beginners should remember. If it goes down so bad like this with big volume, we should not stay in the trade hoping that it will just go back up. That will just kill our account, right? So if you purely based on VWAP, there were one entry, 2 entries, 3 entries for the last 1 day. 2 of them were successful, 1 of them failed, right? So that's in a nutshell what VWAP is. And some people use standard deviation. For example, if you go to VWAP, I'll explain standard deviations in a different session, but in basic theory, that what they say is price will stay within 2 standard deviation, I think about 95% of the time, if I'm not wrong. I think, yeah, that's about 95% of the time, the price will stay within the 2 standard deviation. What I mean by that is some people basically what they do is they will buy here and then they will wait for the price to touch the 2nd standard deviation, which is this, and then they will sell here. This is their, selling point. And then if you look at the beginning of the day, people may buy here and then they may sell here. They will just wait till the stock reaches the 2nd standard deviation and then they'll sell it there. This standard deviation is basically calculated based on the VWAP price. So this standard deviation is basically calculated based on the VWAP price. And then if you further want to get into what this standard deviation is and why is it so narrow here and why is it expanding here, the standard deviation expands as the implied volatility of the stock increases. I know I'm getting too deep here, but then the point is that if you want to use the standard deviations as your selling point, you can also do that. Some people also use the standard deviations as a stop loss. So they will use one standard deviation at the bottom, and then they'll use two standard deviation at the top. So what they say is, if I buy here, my stop loss is this, the one standard deviation. My profit taking is the two standard deviation. So 1:2. That's how some traders that I know also do. So in this case, it went below the one standard deviation, so they would have took loss anyway. Instead of taking a loss here, they would have taken a loss here. So that, in a nutshell, is what a VWAP is. It basically combines the price along with the volume and gives you the actual theoretical value where it should be based on the volume and the price action that's happening. And by far, VWAP is one of the indicators that many people use, right? And it also shows you a trend, like, the VWAP line is going up. That means the actual price itself, the price action itself is up. It's not quite clear, but then it also shows you the trend of the stock, the VWAP. So when we want to know the trend of the stock, then that's where we move to our next topic, that is called moving average. And I'll cover any of the doubts on VWAP in the last 10 minutes of the session. But that, in a nutshell, is what VWAP is. Now, moving average. So let's cover the theoretical definition of the moving average. So moving average is nothing but averaging the price for a certain period of our choice. Most of you would have heard about 10-day moving average or 20-day moving average or 21/8 moving average. Various gurus will be saying various moving averages to be working for them. And, those are like the holy grail moving averages. Again, like I said, there is no such thing as a holy grail indicator. These moving averages will be broken. They are good to show us which direction the market is going. Sometimes if more people use 10 moving average, the price may touch that moving average. And then since most of the buy orders will trigger at that moving average, it may just go up. But then that's it. There's no secret sauce behind. And trust me when I say that, because I myself have created these moving average indicators myself. So I know when I'm writing the code in ThinkScript, there is no such thing that will predict what's happening. These are all lagging indicators. VWAP is the only indicator that's not as lagging as other indicators. When I say lagging indicator, that means the price moves first and the indicator moves second. That will only give us the direction. Okay, so let's look at the moving average. What they say is like, so the reason for calculating moving average is to help smooth out the price. And it basically, when you have the stock going up and down, up and down, up and down, the moving average will basically smooth out, because it basically calculates the average price at each candle. For example, if we select like 20 moving average, it will basically average the price for the last 20 candles. That's what it is, right? So let's go back to, 1 day, daily chart, like each candle represents a day, and this is for 1 year. And let's just say I want to plot a simple moving average. Okay, so I'll go to the studies, I'll select simple moving average, I click add. By default, it gives 9. I want to make it 10. And then I click apply, right? So this price right here is the average of the last 10 days. And this is a simple moving average, so that the calculation will be slightly different. it's basically A1 plus A2 plus divided by average in period divided by number of time periods. So it's basically the average price in these periods divided by the total number of periods. That's simple moving average, right? So if you look at here on this day, 8/22, right? 8/22/2022, the simple moving average, the price is 422, but by the end of the day, the stock closed at 412. See, the price moves first. The simple average, see the curve here, it took 3 days for the simple moving average to turn down. The price moved first, right? So, but here, see, the price is going up and down, up and down, up and down, but the simple moving average has smoothed it out, and it actually showed it's actually going up right here, right? If the price is going down, it will basically show us that the price action is actually going down. Well, we can actually see it like this, but here, see, it's if you close up a little bit, I mean, it's all like it looks like it's going sideways, but if you look at the simple moving average, it's actually going up. It is raising up the 10-day simple moving average, right? So because, let's take this example, because the simple moving average here is 422, but the price closed at 413, which means the simple moving average is slow in showing us the price is going down. There comes the next moving average that is called the exponential moving average. And then I'll show you the calculation. It's a little tricky, the exponential moving average, but I'll give you a clear understanding what simple and exponential does. So this is basically exponential moving average. They basically calculate the value of that particular day, and then they also take the average of the previous days, but they will give more weight to the current price action on the exponential moving average, which means it is faster than simple moving average. It is that. So moving average exponential is your exponential moving average. You plot it on your chart. I want to change the color from blue to red. So red is our exponential moving average, and blue is our simple moving average. Okay. Now let's look at the same day. The simple moving average, which is in blue, is at 422.64. It is still showing like an upward trend or like a sideways trend on this day, but the stock is actually down. Whereas the exponential moving average is 420, which is less than the simple moving average, meaning the exponential moving average will give more weight to the current action, the price action, and it will basically, the line will turn down or change its direction immediately when the price action changes. So we can stay on our toes. If we just follow simple moving average to see the price action, it may take like 3 or 4 days or 3 or 4 candles. But then if we use exponential moving average, it just went down like this. So that at that point, we know that, okay, so the price is actually going down, right? So we can use the moving averages to see which direction the price is going and which direction the price is changing, the direction that it is going or the direction it is changing. And then some people simply use the moving averages as their stop loss, right? For example, if the price cuts the 10-day simple moving average or exponential moving average, they will wait for the price to close below that moving average. Until then, they will trade it, right? For example, if you see here, and I'll also tell why it wouldn't work. For example, let's say here, the price closed above the moving average, and then it closed below it. So one would have exited, but it closed above the moving average. So they will trade SPY from 392 till 421. If they close it here, if they did not close it, they can close it at 412. So 392 till 412, about 20 points, right? But, it's not always that easy. When the price goes in a sideways action, it's not that easy to just buy here. Again, you have to sell here. Again, you have to buy here. Again, you have to sell here. So during sideways action, moving averages will also go sideways because there is no trend. So it's always best to wait when you're using a moving average, to wait when the trend is established like this, when the stock is going up and then the moving averages are also raising. Wait for a pullback, let the price come to that moving average, and then pick up and then ride along with it, rather than just going when trading something which is in a sideways market. It applies the same on a daily chart as well. You can basically wait for the direction. So it's going upside now. So you can wait for it. You can take any of these retests here and then ride all the way up. When the price comes below this moving average, you can close it, right? There is simple moving average, which is slow, exponential moving average, which is little faster than simple moving average. There is one more moving average that's called Hull moving average that is faster than any of these. So Hull moving average is basically faster than any of this. The way that Think or Swim has it is that when the moving average, the Hull moving average is going up, it will show one color. When it is going down, it will show another color. We can also change those colors. So when it is going down, I want red, for example. When it is going up, I want green. Okay. So now this will help us in taking a trade and also exiting a trade, for example, if you just simply follow it. So when the moving average turns green, let me remove the simple and exponential for a second. So you guys can see the Hull moving average. Hull moving average is very quick. Based on its calculation, it's faster than exponential moving average. So when the price is going up, you can see that the indicator turns green. And when there is a slight curve, you can see the indicator turning into red color. That's just the way that Think or Swim has designed it, right? You can see here, it is going down. The Hull moving average is showing it is going red. You see a couple of days, the SPY was actually trying to go up, but still the color is red. That means still there is a downtrend. So this right here is where the moving average, the Hull moving average helps you to not get into the long side because the overall trend is still bearish. Even though the price action is bullish in these 2 days, the overall trend for the last 10 days is still bearish. Don't go long. That's what it's trying to tell. So here it finally turned green here on this day. And then, you have 3 to 4 days of bullish run. And then again, it went down. So here you can again go to a short side. Even though there are few green days here and there, the trend is still bearish, like you can see. And if you want to do intraday, it's going to be a lot messier because it might change green to red quite frequently, right? See, you have a green here, you have a red here. Again, you have a green here, you have some red here. Meaning red just means the trend for the last 10 candles on average, it's less, right? And then it also takes a heavy weight on the current candles as well, Hull moving average. It gives more weight to the current candle than the average, but it still averages, right? So it's better if anyone is using, it's better to use, either 10-minute or 5-minute. So for example, if you see 1 minute, somewhere here it showed red. But then if you basically use the 5-minute, see, it is very smooth. You can trade all the way up and then you can exit here. If you are buying puts, you can buy somewhere here during the retest, and then you can buy all the way down and you can exit here, somewhere here. right? If you have 10 minutes, that's much better. It would have probably let you ride for a longer time. But then when you have big candles, it will also impact your profit loss because it doesn't turn down till the candle crosses it way below, right? So there are, many theories and many other concepts around simple moving average, exponential moving average, and Hull moving average. But the underlying concept is that these are just averages of the current candlestick and the previous candlesticks. I mean, you can remove the Hull moving average. Most people use exponential moving average, right? So we will just plot exponential moving average. I like to change the color to something else. You can use 21. People say 21 moving average is good. And then, you can use a retest on 21. And most people will use a crossover, like 8 exponential or 10 moving average crossing 20 moving average. That's a famous thing, or 8 crossing 20 or 9 crossing 21. So what they do is, this is the slowest moving average. This is for 10 period, and this yellow is for 20. So what they say is, when the 10 crosses 20, right here, take the long position and ride it till it crosses down or till your profit target is met. See, even though the price came down here, you would not exit it because you believe that the trend is strong. The trend is strong to the upside because the 10 is above 20. That is mostly used in, the daily charts right here. See, this is where you can say like the trend changed from bearish to bullish, right? See, the 10, the blue crossed the yellow. That's called a moving average crossover, right? The blue one, which is the smallest, the fastest moving average, the 10-day moving average crosses the 20-day moving average. That means the trend is to the upside. You can ride it all the way till your price target, or you can wait for it to go down again, which I wouldn't recommend. I would recommend, if you're using moving average crossover, you set a price target in your mind. If you're buying on this day, 395, set a price target as 400 or something. I wouldn't encourage anyone buying when the price is far away from the average. Don't buy it. Let it come to the average and then buy somewhere here, right? And same for the downside, right? It went down here, so the blue went below the yellow, which means the 10 is below the 20. It went here, but then don't buy here. Don't buy puts here. Let it come all the way back up. Buy somewhere here. It is possible it could just go up all the way, but you have your stop loss to save you. So buy somewhere here, have some level for your stop loss, and then if it continues in the direction that you wanted, if it continues to goes down, cool. Just have a price target and then just sell it. It is way easier to have a moving average crossover than just to find the direction, just to look at the angle of the slope, right? Or the angle of the moving average. If you have two moving averages, one is slow, one is fast. This is faster, this is slow. When the fast moving average crosses the slow moving average, that's when you think that, okay, the trend has changed to downside or the trend has changed to the upside. And then you ride the wave, right? The bigger time frame that you go, the less number of times a crossover will happen. You see the 10 moving average went below the 20 moving average during the COVID crash, I think. Yeah, during the COVID time. And then the 10 moving average went above around June, I think. And then it retested here. And then it stayed strong till the recent Russia-Ukraine war. See, this is when the price, the 10 moving average went below the 20 moving average. And this is on a weekly chart. If some of you are investors, you can just use this on when to enter a long position, you want to buy Apple, Microsoft, or SPY, you can simply put the weekly chart. You can put a 10-day moving average and a 20-day moving average, and then you can just ride it all the way above here. And then if you are thinking about when should I see my stocks are receive so many messages, right? Like I lost like 95%, I lost like 70% on my long-term portfolio. You don't have to lose it. Just plot a 10-day and a 20-day moving average, or anything, any moving average, like 50-day, 100-day. And then when it crosses below, sell it. You can buy it. I think it's crossing above now. It's trying to cross now, like this week. This is like a bullish week. So I think finally after the war, finally the weekly, the 10 is above 20 as of today, right? I mean, you can take a long position here, or you can wait for a retest and then take a long position, right? The only problem, if you, let's just say instead of 10, I'll take 50. And then instead of 20, I'll take 100. If you give the longer times, you would never see a crossover because you have given a bigger sample to average. It's going to take forever for you to see the crossover. But still, I don't know, you have to go to a custom chart to do that. But the point is that you can simply use 10 and 20 and manage your intraday. Like you can use like a 1-day 10-minute chart. You can enter a position when the 10-day goes above 20 on a pullback and then ride it. Or if you are an investor, you can use the weekly chart. You can simply plot 10 and 20 and then simply ride it. If it makes any of you feel better, there's a 100 million trader. His name is Koala Maggie. All he uses is 10-day and 20-day moving averages. He uses on a daily chart. He doesn't use anything, and his literal net worth is $100 million. He's from Sweden. He doesn't use any indicators. All he uses 10-day moving average and 20-day moving average. Don't go for any crazy, anything. Simple. Keep it simple. 10-day, 20-day. Or if you are a VWAP guy, you like the VWAP because that's what most of the hedge funds uses. That's also fine. But now you know that instead of simply looking at a plain chart, if you plot a moving average or a moving average crossover, you can clearly see the direction. If this crosses above here, you go long, again, it went down, right? So that's when you need to have some pattern recognition. This is called a bear flag, because it came all the way down and then it is trying to go up. But we will look at the patterns in a different session. Let's for now focus on moving averages. And I personally like Exponential on shorter time frames. And I use simple moving average on a longer time frame. And I am slightly crazy, so I use multi-time moving averages on one single chart. That means I will use these moving average values and the smaller time moving average values on one single chart. I can bring up one of my charts here. You can see, I have, multiple clouds here. These are all multiple time frame exponential moving average. If you see here, it's 4 hour. I can change, this is a custom thing. But anyway, like I said, I like 20-day moving average on daily time frame and 10 and 20 on weekly time frame. So these are perfect. These are awesome. All you need is this if you're an investor. If you're a day trader, yeah, you can go to 10-day time frame, 10-minute time frame, and then you can simply trade based on the moving averages. If all you trade is S&P 500 or any one ticker, you just need these 2 moving averages. So I will stop there. I know we only have like 5 more minutes, but I think we can continue till 5:05. And I will pause for any questions that anyone have on moving averages or VWAP or moving average crossovers. You can type What is
Yeah.
8 screen LR right, top right screen? Oh, okay. So so this is okay. So you can have a grid of your own, and then you can basically, I mean, if I click this, I will get two screens. So this is a grid. So you can have a single grid like this, or you can have two grids. And then if you want to look at SPY on this screen, and if you want to look Apple on this screen, if you want to look two charts side by side, you can look at it. Yeah, don't care. Like, forget what you see here. I have some crazy screens here, but yeah, you just need one screen. That's all you need. So let me remove all studies. I don't want to confuse you all with all those things. The moving average applies to all kind of stocks. I just gave SPY for example, but then moving averages apply for anything. Yeah, they apply for all stocks or Bitcoin or anything for that matter. If you are looking at that, there are Bitcoin features on Thinkorswim. So yeah, it applies to all time frames. It applies to all Tesla if you are a Tesla guy. Let me see. How do we plot the levels targets? Okay, so levels and targets is something that you have, like, there are many ways on how you can few, let me tell few that I know, is like you take the pre-market high and low. For example, you go here, bottom corner, you have this arrow mark, you have this price levels, right? So before the market open, you can take this. For example, this is one price level, right? So you see the price level is 164. And then the bottom, the lowest price level for pre-market, for example, is 158, right? So you can basically use these, and then you can say like, okay, so if the price crosses 164, I will buy, and then I will ride all the way till it crosses below. Or you can also go back like 20 days, and then you'll see, I mean, Tesla is just going up, so it's a bad example. But let's take SPY, for example, right? So you can say the pre-market low is this, right? So you can say, okay, so this is my stop loss, pre-market low is my stop loss, and then the pre-market high, this is a pre-market high, so this is my entry. So you can say like, if the stock goes above the pre-market high, or if the 10 moving average goes above 20, I will basically take the trade, but this is my stop loss. The pre-market low is your stop loss. Or you can basically go to all the way back to the daily chart, and then you can say like, you can plot this right here. So this is one level, right? This is one price level. I have to draw it slightly up. See here, it went somewhere around 409 level, and then 2, 3. So 409 or 410 has something happening around that price range, right? Like here, there is a lot of price action around that price 1, 2, 3. So when price crosses 410 or 409.95, whatever, you can buy it, or you can keep that as your price target, right? For example, when the 10-day moving average goes about 20-day on a pullback, you will buy. Where will you sell? You will sell here. Why? Because there was a lot of resistance here in the last few months. Couple of times it touched it and it came down. So you want to be cautious around this level, so you can sell it here. Levels is nothing. It's very easy. Like, you just look with your eye, and then you see, okay, so this is one level. You go here, select this. Okay, so this is one key level. You don't have to ask levels anyone, honestly. I mean, you can just look at So this is one price level. For example, these are key price levels. They say like the more number of times a level is touched, the better. This level 4 or 410 appears to be the level that's been tested multiple times. So I would say in the near term future, 410 is probably a level of interest. So you can use that as your, profit taking margin. Oh, I think that came to me directly. Okay. So those questions came to me directly. So, but anyway, so one of the question is about levels. So you can plot the levels. I mean, this appears to be the, support level, one more level around here. So you can draw these levels and you can also trade based on the levels. But yep, that's about it. Any questions, anyone on moving averages or VWAP?
You can raise a hand too. I can unmute.
Yeah, if anyone wanna ask, you can raise the hand and Danu can unmute you. Or if not, you can post in the chat. It's a pretty straightforward, like VWAP and moving average are, I think, like very basic, the first level indicators. But for me, when I don't know anything about indicators at all, when I looked at these VWAP and moving averages, I was like, wow, this is cool. But like I said, right, like a price can break the moving average. It can come down below the moving average. In short, moving average will just show the trend of the price action. It will not show anything. So just use it as how the trend is going. Don't use it for anything. Amar raised his hand. I don't think I can unmute. Danu, you want to unmute him? Amar?
Yeah, hi. Thanks for the good information. This is very beneficial. So I have one question regarding this think or swim. I have a chart on my laptop. I was just trying to mimic your thing. But since I have a lot of charts on my machine, how can I create the new chart brand? That means start with the plain slate.
Well, go to studies. Well, you can close all the other charts. I mean, do you see my screen here?
Yes.
You can close everything. You can close all these. Just keep the main one. And then you can go to studies. If you have any studies, just hit remove studies, all studies. It will remove everything. And you should have a plain chart, plain clean chart here. And if you want to detach this chart, I know you probably know how to detach. You can detach this chart as a new chart. But then if you want to basically clear up everything, you just have to go to studies, remove all studies, and close all these windows. Make sure you have a single grid. You don't have multiple grids. And that should be it. That should clear everything. Just go to studies, remove all studies.
Yeah, they don't have a feature like just like we create a new file. They don't have a feature like create a new chart and save it as a new pattern for us.
They do. For example, if you want, for example, you want the moving average. So you can just keep this. I'm just showing this an example. You just want this as your chart. You can go here under this box thing, and then you can save grid as, and then you can give a name like exponential something, right?
Okay, yeah.
And then you can just save it, for example, and then see it's here. And then, for example, you messed up something, you got to here, and then you go to exponential test. As soon as you click it, everything will be gone, and you have your chart of your own, like the one that you always wanted. Yeah. So you can plot all the indicators you want, and then save it as a grid. And anytime you want to open your own setup, you can open this.
Thank you.
Notice. We have one more minute. No questions. Then have a great evening, everyone. And if you have any topic.
Sorry, Vishwa. I think Ravi posted to me, and the question is, what indicators do you currently use?
Oh, me. This is my setup. I had to take some break because of work for trading, but I had to recently turn back everything online, and this is my setup. So this is a 20-day 20-day simple moving average on a daily time frame. Even though you look at a 10-minute chart, I have a daily simple moving average. The reason why I have it like that is because I believe there is a lot of price action that happens around the 20-day moving average. So when a price cuts the 20-day moving average, it comes for a retest and then it goes above. And anytime it comes for a retest, it goes above. So my setup is pretty simple. For my swing trades, I use a 4-hour 3450 exponential moving average crossover. Anytime the 4-hour 3450 is bullish, I wait for a pullback to the 20-day moving average and I take a long position. That is for swing. That means if I am in office, I cannot manage my position. And then I set an auto sell on my not my Thinkorswim, but on my VBull. When a price hits a certain point, it will sell. And for my shorts, it's the same thing. It's inverse for shorts. So when the 3450 goes below, I will wait for a pullback, and then I'll take a short position here. In this case, it did not work. But then what I do is whenever the 3450 goes above, I will wait for the price to come back and retest the 20-day moving average. And then I take a position based on the direction of this 3450 4-hour. That's because I couldn't sit in front of my trading station because I have to be in office. I couldn't trade. So that's why I had my swing only setup. And then for a day trade, I have the 10-minute 513 and 112 EMA and 7289. The 7289 is just for basically for my direction. It just shows the direction. So this is what I use to stay in the trade. The 5 and 13 moving average exponential on a 10-minute time frame. Like I said, it may be slightly confusing only because I use multiple time frames in one single chart. I don't use one chart for one day. I don't use one chart for weekly and all. I use one single chart and I have all the time frames in one single chart. Because like I said, I create my own indicators. So I see this is a weekly exponential moving average. See 10 and 20. I have it in the same chart. This is a 4-hour moving average. I have in the same chart. This is a Bollinger Band. But then this is the 2.3 standard deviation. This is 2.3 standard deviation. It has this whole big theory. But then in short, what I do is I use this 20-day moving average, simple moving average on a daily time frame. I'll wait for the price to come here. When it comes close, I'll take a position based on the 3450 direction. And for a day trade, I don't use these indicators to tell me what to do, what not to do. I have my own scanners, and I try to find the stocks that are moving up, like Lucid or Google or whatever stocks were moving, or Tesla. I get a list of all the stocks. I don't think I can see today right now because, well, you can see it right here. If you can see my screen, I have all the stocks that are moving that pop up on my scanners. So based on the dollar volume, I pick whatever stock is making moves, and then I'll take a trade, just do a scalp based on the moving averages from here all the way here. Or if I basically have a strike, I'll let the contract go in the money, and then I'll come out. So the scanner to get all these stocks right here, like for example, Lucid, I think I got the alert at around 1140 something. So that's good money there. But yeah, for day trade, you need to know the stocks, you need the scanner. And I mean, we have our guys who also tell you guys the stocks like Danu and Venu and a few other folks. But if you want to set up your own scanner, the scanner is in the ThinkSabio education group. You're more than welcome to use those scanners. You will find all the hot popping stocks alerting you when they come in. So you can use that. So this is my swing setup, and for day trade, I use this. I'll pick the first one or two stocks based on my comfort level, and then I use a dollar volume, and then I'll trade it. I sort based on the dollar volume. So I have a lot of moving average. I'm a trend-based trader. I like trading with it in the trend. I also keep an eye on the standard deviations because they have it. They're unique. I like standard deviations. That's why my screen name is also deviate standard. It came from standard deviations. So. All right, guys, thank you all. If you have any other topics in your mind, you can feel free to post in education group. If not, we will keep doing these sessions over next few weeks. And then you can also share your feedback in the group if you like these sessions. So it will help us understand if there are any other topics or any things that we have to improve or change. Thank you all. Have a great evening.
Yeah, thank you, Vishwa. Thank you, everyone who joined. Like Vishwa just commented just now, see if you can provide feedback that would encourage others who are not participating also to know the value, and they can gain knowledge. As we all know, if we were not gone to school, college, we would have had different opportunities compared to who are educated, right? As simple as that. We want everyone to learn basics, so it's easy for them for execution. It's a collective winning mindset. As you all know, Sai is more of community oriented rather than commercial. He did it for 3 years for free. I believe he spent around 500K out of his pocket just to meet his passion and deliver it to the community and make more people get awareness. 500K, think about it. How many would have spent that kind of amount who all we joined today? So it's our responsibility, at least few of us, to communicate, encourage, bring people, make them understand. Financially, it's not easy people to step up because we are scared to lose all that. We can throw or get away from those inhibitions with the help of all of us encouraging or giving guidance to people who are not aware. That's my goal, right? That's how I think. I saw Sai and then I felt, why can't I learn this? I learned a little bit. I'm learning. It's a continuous process, but definitely I can do on my own, whether I win or lose, right? Same thing so many people are doing in our group. Definitely I see a lot of people, they have joined by their names, I can recognize. Same thing, Deviate volunteered or Vishwa volunteered to help out. Same thing, we are all coming as a community to grow one another. So that's just my opinion. Thank you all. Otherwise, have a rest of the weekend with your family, and let's meet up for Monday trading. Thank you all. Bye.